So Quest Resource, symbol QRHC on the NASDAQ. The company is a provider of waste and recycling services to customers across multiple industry sectors that are typically larger, multi-location businesses. Quest creates customer-specific programs and performs related services for collection, processing, recycling, disposal, and tracking of waste streams and recyclables. Effectively, they connect waste generators with recyclers. That's the easiest way to put it. The stock is currently trading at 762 with a market cap of 150 million. The stock did trade quite a bit higher earlier in the year, but has since fallen off and is really just flat so far year to date. Looking at the last quarter, Q3 2024, revenue came in at 72.8 million, an increase of 3.3% over the prior year. Gross margin fell by 5.9% to 11.7 million. As gross margin profit fell by 5.9% to 11.7 million, as gross margin fell to 16.1% from 17.7%. Adjusted EBITDA came in at 2.5 million compared to the prior year's 3.7 million. The company had a net loss of 3.4 million compared to a net loss of 2.1 million, or a loss of 16 cents per share compared to 10 cents per share, respectively. The quarter and year to date really have been relatively flat overall, but the company did note for the third quarter that cost of revenue as well as SG&A was negatively impacted by transitioning to their new vendor management system. As well, some customers have actually been seeing weaker volume, which they do believe is temporary, as they do highlight the customer relationship is still intact, but the customer themselves, they're seeing economic weakness, create less waste, and that means that they'll be getting less volume, and ultimately Quest would be receiving less revenues from them. Looking at a longer term view, we can see there's really been little growth since 2022. In 2021, the period the company conducted acquisitions, which is why you see such a sharp ramp up of revenue from 2020 to 2021 to 2022. There was the acquisition period. And prior to that, when they were consolidating down, you can see 2016, 2017, 2018, revenue was consolidating. They were really picking apart the company for higher margin services that they were providing and really trying to make the business profitable. And you can see their gross margins did uptick. So they did do that successfully, but we're not seeing that growth, organic growth in the last couple of years. A couple of positive factors which may influence that, which management has highlighted, is they expect in 2025 to have 20 million more in incremental revenue from net new clients. As well, the company expects to be able to save 2 to 3 million in recurring costs once that new automated vendor management program is fully implemented. Shifting to the balance sheet, however, there is significant debt on it at this time. The company has 71.9 million in net debt, which off the trailing EBITDA of 16.3 million is net debt to EBITDA of 4.4 times, which is quite high. The debt is really, it has a quite high interest rate as well at 11.8% for the last quarter, really bearing down on the company's profitability or potential profitability at this time. You can really see when you go look at the income statement that they're bearing on that operating profitability, slight loss at this time, but then once the interest expense comes in, it puts them firm into a net loss. The company is in the process, which it expects to be completed by the end of the year, to refinance at a lower rate. As well, the debt is all floating, so they will just benefit in general from any interest rates cuts, regardless if they are able to refinance or to what degree if they keep it floating. A quick look at valuation. The company is trading at 14 times EV/EBITDA, but given the lack of growth, that is quite expensive. In conclusion, growth is weak for the last couple of years. Near-term customer adds may add some growth, but at the same time, some customers are seeing economic weakness, but they do have a broad array of customers. So normally when you have one weaker, you end up having one stronger, and it just kind of shakes out that way. But you really need to see where that balance ends up between new customers and existing, where the growth in the financials, and we haven't really seen any growth at this time. The balance sheet isn't great, partly due to the high interest rate on that large chunk of debt, and it is quite leveraged at this time. And all that together really makes the valuation quite pricey due to the lack of growth, due to the not superb balance sheet. It's not the worst thing ever, but it's not great either. The company really is in the stage where it needs to show the results of both revenue growth and bottom line growth. You need to see that debt refinancing, and then you need to start seeing organic growth. And then really that's where you want to see from there. For now, we'll continue to monitor for some more appealing financials in the future.
Yeah. When I heard the name, I thought that it was a junior exploration company. Yeah, no, it's not, but it's definitely, just in terms of current growth the last couple of years, profitability, balance sheet, it just, we're monitor a company like that, but it doesn't meet our criteria, right? Like right now, there's just so many other choices that are, hitting in terms of revenue growth, hitting in terms of good balance sheets, and hitting in terms of profitability. We're looking at, about 1,000 companies in the US right now that have, net cash, have from operational profitability, and we're looking to screen out growth and then interview management teams, and those are the names we're looking at. Quest, interesting, but would not meet that criteria.
Yeah. And even on the growth part, it is in an industry which
Mhm.
you're not expecting the greatest growth ever. But so you can't really pay a premium valuation unless it has something else
No,
behind it, which it really doesn't at this time.
no.